Two things happened in the stock market today that confuse almost every beginner investor. A major company reported record profits. Its stock fell 9%. The world's most valuable company announced its CEO is leaving. Its stock barely moved. Both of these outcomes seem to make no sense. And yet, they happen constantly in financial markets, because most people fundamentally misunderstand how stock prices actually work. Understanding these two things will make you a significantly smarter investor, regardless of when you are watching this video. Let's start with the first one. Why do stocks fall after good results? Today, Meta, the company that owns Facebook, Instagram, and WhatsApp, reported strong first-quarter earnings. Revenue grew, profits grew, every headline number beat what analysts expected, and the stock fell 9%. Not because the results were bad. Because Meta announced it is spending between $125 billion and $145 billion this year on artificial intelligence infrastructure. That number, $145 billion in a single year, spooked investors. Not because spending on AI is wrong, but because the market looked at that figure and asked a simple question. When does the revenue catch up to the spending? Here is the principle that explains this, and it applies to every company, in every sector, in every market, at any point in history. Stock prices do not reflect what has happened. They reflect what investors believe will happen. By the time a company reports its quarterly results, those results are already 3 months old. Professional investors, the people who move markets, have been modeling what those results would look like for months. When a company beats expectations, it often means the market had already priced in that beat. The good news was already in the price. What moves a stock after earnings is not the past results. It is what the results imply about the future. If a company beats its past results but raises its spending dramatically, the market worries about future profitability. If a company misses its past results but raises its guidance for the next quarter, the stock often rises because the future looks better than the past. This is called the expectations gap, and it is one of the most important concepts in investing. Think of it like this. Imagine you expected a friend to bring you one present for your birthday. They bring you two, but tell you they are spending all their savings to do it and may not be able to afford anything next year. Are you happy? The past result, two presents, was better than expected, but the future outlook just got worse. That is exactly what happened with Meta today. Strong past results, alarming future spending, stock falls. This explains a pattern you will see repeatedly throughout your investing life. Companies that beat earnings and fall. Companies that miss earnings and rise. Understanding the expectations gap is what separates investors who are consistently confused by markets from those who understand what they are seeing. Now the second story. What CEO changes do to stock prices? Today, Apple announced that Tim Cook, who has led the company since Steve Jobs died in 2011, will step down as CEO in September. John Ternus, the company's hardware chief, will take over. 15 years of leadership, the first company to reach $3 trillion in market valuation. And Apple's stock barely reacted. Why? Because markets had time to prepare. CEO transitions affect stock prices differently depending on one critical variable, whether they are expected or unexpected. An unexpected CEO departure, particularly one with negative connotations, a health crisis, a scandal, a sudden resignation, typically causes a sharp stock price fall. The market hates uncertainty. A sudden leadership vacuum creates immediate questions about strategy, direction, and confidence. An expected, planned, well-communicated CEO transition, where a successor is named, where there is a clear handover period, where the company's strategy remains intact, typically has a much smaller impact on the stock price. Tim Cook's departure is a planned transition. A successor has been named. There is a clear timeline. Apple's strategy is well established and not dependent on any single individual. Compare that to a sudden CEO departure, like when the CEO of a major company resigns unexpectedly amid a scandal or has a sudden health crisis. Those events typically cause immediate sharp falls because the market cannot price an unknown. Here is the investor framework for CEO changes, and this works at any point in history for any company. Ask 4 questions when you hear a CEO is leaving. Question 1. Is this planned or unexpected? Planned transitions are far less disruptive than sudden ones. Question 2. Is there a clear, credible successor? A named internal successor who knows the company reduces uncertainty dramatically compared to an external search. Question 3. Was the departing CEO the strategy or the executor of the strategy? Some CEOs are so closely identified with the company vision that their departure genuinely threatens the direction. Others are excellent operators executing a well-established plan that continues without them. Question 4. Is the company currently performing well or struggling? A CEO departure at a strong company with clear succession creates far less disruption than the same departure at a company already facing challenges. Apply those 4 questions to Tim Cook and Apple today. Planned departure, clear successor named, strategy well established and independent of any single person, company performing well. Result: minimal market reaction, exactly as you would expect. Now here is how both of today's lessons connect into one principle that will serve you for your entire investing life. Markets are not a voting machine for whether a company is doing well today. They are a weighing machine for whether a company will do better or worse than currently expected in the future. Good results that were expected often move a stock less than mediocre results that were feared. A CEO leaving who was expected to leave often moves a stock less than a CEO staying who was expected to leave. Every time you see a stock move in a direction that seems counterintuitive, go back to this principle. Ask not what happened. Ask how it compares to what was already expected. The gap between what happened and what was expected is almost always the explanation. Here is today in 30 seconds. Stocks fall after good results when the future outlook implied by those results disappoints relative to expectations. Meta beat earnings but alarmed investors with its spending plans. Past results were strong. Future costs look enormous. CEO changes matter most when they are unexpected, when no successor is named, and when the strategy was personally dependent on the departing leader. Tim Cook's planned departure with a clear successor created minimal disruption. The master principle: markets price the future, not the past. Understanding the expectations gap is the most valuable thing you can know as an investor. Everything in this video is for educational and informational purposes only. This is not financial advice. Please always do your own research and speak to a qualified financial professional before making any decisions about your money. We use an AI avatar as our presenter. All research, scripting, and analysis is done by our human team. Subscribe to Global Finance Market News. New videos every single day.